A business owner asks me, can I afford this $20,000 piece of equipment? My answer isn't going to come from looking at today's bank balance. Let's say you open your business bank account this morning and there's $60,000 sitting there. The equipment you want costs $20,000. Easy decision, right? You have $60,000, spend $20,000, you still have $40,000. Except that's not how I want a business owner making a $20,000 financial decision, because that $60,000 sitting in your bank account isn't necessarily $60,000 that's available to spend. Some of that money may already have a job. You may have payroll coming up, payroll taxes, sales tax, vendor bills, rent, credit card payments, loan payments, insurance, quarterly estimated taxes, inventory purchases, and other expenses that haven't hit your bank account yet. So before I tell you whether your business can comfortably afford that equipment, I want to look at the bigger financial picture. First, let's look at cash flow. How much money is consistently coming into the business and how much is going out? More importantly, when is that money coming in and going out? A profitable business can still experience periods where cash is tighter simply because of timing. If you spend $20,000 today, what does your cash position look like next week? Next month? 3 months from now? That's what I want to understand. Next, let's look at profit. Is the business consistently profitable? How does this year compare with last year? Are your margins improving? Is the business generating enough profit to support an investment of this size? Then I want to look at debt. What loans does the business already have? What are the monthly payments? What's sitting on the business credit cards? Are there other equipment loans or lines of credit? Because we need to understand the obligations the business already has before adding another one. Then we look at upcoming expenses. Maybe your insurance renewal is next month. Maybe you have a large inventory order coming. Maybe business slows down during a certain season. Maybe you're planning to hire someone. Maybe taxes are due soon. Those things don't necessarily mean you shouldn't buy the equipment. They simply need to be part of the decision. Then comes another important question. What is this equipment going to do for the business? Is it going to allow you to complete more jobs, serve more customers, reduce labor hours, replace equipment that's constantly costing you money in repairs, improve efficiency, create a new revenue stream? If you're investing $20,000 into your business, I want to understand what you're expecting that $20,000 to accomplish. Then we can look at your options. Do you pay cash? Do you finance it? Would financing allow you to preserve cash for operations? What would the monthly payment look like? How would that payment affect cash flow? And what does your CPA or tax professional recommend regarding the tax treatment of the purchase? Now we're making a financial decision based on information, not simply on whether there's enough money in the bank today. Because here's the question I'm really trying to answer. It's not just, do you have $20,000? It's what happens to your business after you spend the $20,000. Can you still comfortably cover payroll? Can you pay your bills? Can you handle your taxes? Do you maintain an appropriate cash cushion? And does this purchase help move the business toward its goals? That's the value of having accurate bookkeeping and financial reports. Your numbers should help you answer real business questions. Can I hire another employee? Can I purchase equipment? Can I open another location? Can I increase my owner's pay? Can I take on another loan? Those decisions require more than opening your banking app and looking at the number on the screen. Your bank balance tells you how much cash is there today. Your financials help you understand what that cash needs to do tomorrow. Good financial decisions require more than checking your banking app. And that's the exact difference.